But I do have a question for you though. Have you ever got to this time of the year and gone, okay, there are some assets that have been a bit lazy, or they haven't returned what I was thinking that they might return, or they might have gone down and you don't want them in your portfolio anymore? Properties, shares, otherwise, it's not financial advice. Have you ever assessed that to actually do some tax loss harvesting where you actually sell it and take the loss against your tax?
Well, let's go there. Let's get some advanced shit now. I like it. Can I just, do the thing you should never do on a podcast in general? Can I ask you a question instead of answering your question, then answer your question?
I feel as though I've given you that strategy.
I watch you dodge. You'd be like, you're like Neo in the Matrix sometimes. I'm like, ooh, doesn't like that one.
Take your question and I'll answer that with another hypothetical.
Are you surprised by how manipulable the tax system is?
Yes. Hang on. Knee-jerk, yes. When I understand the people who designed the tax system, no.
Interesting. I'm still to this day surprised for it. There is a book, I'll look it up later in the episode, but there's a book I would recommend every business owner reads. It was written by the guy who was Kerry Packer's accountant. And he does an update of the book every year with the new rules and things that are in it. But when I read this book, I was absolutely blown away with what a difference certain decisions can make to the amount of tax you pay.
Isn't it funny?
And Kerry Packer is obviously famous for he didn't pay tax. And everyone's like, how is this guy not paying tax? And then you realize how much he spent not to pay tax. Questionable if it was worth it to that degree. But we'll come back to that. I still think it's an impeccable story. And to hear it from the perspective of his accountant and what he did, really good book for understanding the tax system. We'll grab a link and reference the title when I can think of it at another point. Anyway, coming back to your question here about tax loss harvesting, yes, I have actually partaken in that. So for anyone who doesn't understand tax loss harvesting, pretend you've got two assets. They're going to be two houses in this example.
Love it.
Yeah, you've got a property that's made $100,000, so you bought it for $1 million, and now it's worth 1.1. And then you've got another property that you bought for $1 million, but now it's worth 900,000. Now, if you were to sell them, you would have to pay no tax because the gain is offset by the loss.
Totally.
Right. So, and Charlie, the question becomes, why would you do that? Because it's an ability to neutral out some tax. So, if in an example, and I'm not naming people here, but if you got a bit speculative in a crypto run last year, not naming anyone. We might need to take a moment to check if you can get up off the floor here.
That's right. My shrine. Yep, go.
If you potentially lost some money in some very speculative crypto investments, not naming people again, and let's say you did that, is that you could have sold that to then create a loss so that when you were to sell a different asset, you could offset it in another way. So I don't think anyone should go out there and intentionally buy things to do tax loss harvesting. But if you end up in a situation where you've got some investments that you could potentially sell in certain financial years to offset gains on other things that have gone well, very powerful strategy.
Yeah, totally. It's funny. I still have some shares that I bought that tanked. And I bought these things a decade ago and I still refuse to sell them, even though I get some kind of tax loss harvesting, because I feel like the benefit of me seeing how much they've dropped is a stark reminder of what not to do in investing.
Well, I don't know if you know this, but you can actually carry forward.
Yeah.
So even if you were to sell them in this financial year and let's say create a $100,000 loss, if you sold a property a few years later, you could then use it. You just have to crystallize the loss, which is the thing. You actually have to go through the transaction is the thing you would need to look at there.
I thought it's interesting. When I talk to friends out of the United States, this is so common and so openly spoken about. It is okay, cool, you're doing tax. Have you thought about your tax loss harvesting? How does this play in? But it just doesn't seem to be as much of a topic in Australia. I just don't see a lot of people thinking through assets that way of saying this is a way to sort of clean the slate, look at next year and see what better opportunities there are to run. Is there some kind of psychology in Australia or is it just not as strong? I know you and I talk about it, but yeah.
I'm going to make the suggestion here that the tax game for someone who is employed in a PAYG is very different than someone who's in a business.
Incomparable.
Yeah. So when the majority of a population is PAYG, like we see here, and there is a smaller business community and the free flow of information in the Australian community isn't as strong, there's just so many limited people that know about it that it kind of doesn't get spoken about.
Yeah, that's a fair observation. That is fair. Hey, fellow business owner, if this topic and value-packed short video has resonated with you at all, and you want to dive deeper into creating wealth inside and outside your business, check out the full episode by clicking the link on your screen or in the description right now.